Hello and welcome to an FX Times daily video recap. I'm CMS Forex market analyst Nick Nassad. Today's Tuesday, December 22nd, 2009. The general theme we've been seeing most of December held in today's trading as the greenback gained against the euro. That came even as stocks around the world, in Asia, Europe, and in the US, were positive today, which continues the break of the correlation between higher stocks and a weaker greenback that we had seen throughout most of the year. Zooming the pair in to see the most recent price action, we see that today we fell below a support level that had held the previous two sessions around the 1.4270 area. Today's low was the lowest the euro has been against the greenback in 3.5 months. And the pair reached this low after we had some positive US data from the housing sector. There are two reasons for the recent greenback strength. First, we've seen that speculation that improved economic US data will provide the Fed with the justification it needs to raise interest rates. That has helped to make the dollar more attractive to investors. Secondly, we're also seeing some end of the year flows as traders that may have bet against the greenback throughout most of the year are now closing and squaring their positions as the euro has been pressured. Similar dynamics are at work with the dollar-yen pair as the greenback continued to extend its gains against the yen following yesterday's rise above the 91 level. Overnight, the Bank of Japan governor reiterated and confirmed that Japanese interest rates will remain near zero. The interest rate differential now between the benchmark 2-year Japanese and US government bonds favor the US by more than 70 basis points, and also is a reason the greenback is becoming more attractive compared to the yen. Earlier in the year, the dollar had become the main funder for carry trade, while now it seems that the yen will be reclaiming that mantle. This is about a 2-month peak for the pair, and we now approach the 92.30 level, which was our high in late October. So we should see some level of resistance once we hit that level here. Before I go on to look at some other currency pairs and market highlights, let me take a look at today's US fundamental data. As I mentioned, we had a very positive release from the US housing sector as existing home sales rose 7.4% to an annual rate of 6.54 million. That was the highest reading since February of 2007 and a figure that beat expectations, which had called for a smaller increase. The rise in November follows an even bigger 10% climb in October, when there was a big rush to close deals as potential homebuyers faced the looming expiration of the government's $8,000 home tax credit. Originally, the tax credit was scheduled to expire on November 30th, and that helped to boost sales in the month of November as well. As you can see on the chart to the right, we have two very strong months of gains, and at the same time we're seeing mortgage rates continue to decline. Now that tax credit has been extended till June, and with low borrowing costs and cheaper homes, those factors should help to continue to drive sales, though there might be some pullback in December. Also to note from the release, the inventory of unsold homes declined 1.3% to 3.52 million, which was a 6.5-month supply at the November sales pace. This is the lowest supply in 3 years. A second report showed that for the month of October, home prices rose by 0.6%, a figure that beat forecasts. Higher housing prices would work to improve confidence and also to increase spending, as those selling their homes have more income to spend. However, despite the higher headline reading, September's flat reading was revised downward to show housing prices slipping 0.4% in the month of September. So now traders will await the S&P Case-Shiller 20-city and 10-city indexes for further insights into how housing prices fared in major metropolitan areas. So following those two better than expected releases in the housing sector, we did have some negative reports from the US as well. First, the final version of third quarter GDP was revised downward to 2.2%, which was lower than we had seen in the preliminary estimate that had GDP growing 2.8%. The reason for the decline was a bigger reduction in capital spending than first estimated. There was also lower construction and deeper cuts to inventories than previously reported. Still, this data is now somewhat dated as we're already coming onto the end of the fourth quarter, and now traders will be more focused on what kind of growth we had in the fourth quarter. Expectations are for about a 3% annualized rate. Also today we saw that the manufacturing activity in the Central Atlantic region pulled back in December from positive territory after expanding during the previous 7 months. The reading hit -4 from November's 1. All the broad indicators of activity, shipments, new orders, and employment were in negative territory, which is disappointing, though we did see that expectations in those in shipments and new orders did increase compared to November. So while current conditions are sort of deteriorating, firms still have rather okay expectations going forward. Turning back to our market highlights, we look at the pound-dollar pair, with the greenback gained rather strongly against the pound, falling below the 1.60 level to a low near 1.5930. The pound was pressured by its GDP release, the final version for the third quarter, which, while revised upward to show only a 0.2% decline compared to a 0.3% decline for the quarter, some expectations had been for a better reading than that, even perhaps some positive growth. So that did not come to pass, and the pound did slide in today's trading. We had been squeezing the past 2 sessions with this support level here and another trend line, creating a sort of wedge pattern that you could even take back to this high. And we see that this level around 1.60 was our important flash point, and we broke below it, and we'll see if we have a retest of that in tomorrow's trading. If we zoom our pound-dollar pair out for a much more longer view, we see that we have this rounded top action happening here throughout the month of October and November, in the fourth quarter pretty much, with perhaps our left shoulder here, our head here, and another right shoulder here. So we've broken below that neckline after consolidating, which had been between the 1.62 and 1.63 area, and we're now approaching this resistance zone. One currency that did see some gains against the dollar was the Canadian dollar. We saw a rather strong move in favor of the Canadian dollar yesterday, which ran up against this upward sloping trend line of support. And following a counter rally in late New York trading yesterday, the Canadian dollar saw strength in overnight session, retesting that upward sloping line and around the 1.0550 area. And that is pretty much where we are now in the end of today's global session. In comparison, the Australian dollar-US dollar pair continued to slide in favor of the greenback, so we're definitely seeing some Canadian dollar strength, which is not apparent in other quote-unquote commodity currencies. The New Zealand dollar-US dollar pair, meanwhile, slid in today's trading and then fell rather sharply around 5 p.m. as we saw New Zealand post its third quarter GDP, and the figure came in lower than expected, so that pressured the Kiwi in late trading today. Now let's see what we can expect from fundamental docket in the upcoming session. Overnight, we have Germany posting its import price index, while the UK releases data on mortgage approvals, services sector, and the Bank of England meeting minutes. Tomorrow, the US will post data on personal incomes and spending, the core PCE price index, a very important measure of inflation for Fed officials, and we're also going to see new home sales, which followed today very strong existing home sales, so we'll see if we have a positive report there as well. Finally, we get the revised University of Michigan consumer sentiment for the month of December. And that will wrap up today's broadcast. For more news, videos, and analysis, please visit our site fxtimes.com. I want to thank you for watching and happy trading.